There's one thing every bank, mortgage lender, car dealership, and employer has in common. They all sell you insurance or push you into buying it, and almost none of them explain what you're actually getting. Most people in the US are paying for coverage they don't fully understand, missing coverage they desperately need, or both at the same time. By the end of this video, you'll know exactly what every major type of insurance in the US actually does, what it costs, and the number at the end that will change how seriously you take one of them forever. Let's start with the basics. Insurance is a contract. You pay a company a regular fee called a premium. In exchange, if something specific and expensive happens to you, they cover the cost, up to a limit, minus whatever you agreed to pay out of pocket first. That out-of-pocket amount is called a deductible. The higher your deductible, the lower your premium, because you're taking on more of the initial risk yourself. The lower your deductible, the higher your premium, because the insurer covers more from dollar one. Two other terms worth knowing before we dive in. A coverage limit is the maximum amount an insurer will pay for a claim. An exclusion is a specific situation or event the policy explicitly does not cover. And exclusions are where most people get blindsided, because they assume they're covered for something they're not. The first type is health insurance. This is the most complex and arguably the most important insurance most Americans will ever deal with. Health insurance covers medical expenses, doctor visits, hospital stays, surgeries, prescriptions, preventive care. In the US, most people get health insurance through their employer, who typically pays part of the premium and deducts the rest from your paycheck. If your employer doesn't offer coverage, you can purchase a plan through the Affordable Care Act marketplace, also known as the ACA, where you may qualify for subsidies based on your income. Health insurance comes with several moving parts. The premium is what you pay each month just to have coverage. The deductible is what you pay out of pocket before insurance kicks in. On many plans, this is $1,500 to $5,000 or more per year. The copay is a fixed amount you pay for specific services, like $30 for a doctor visit. The out-of-pocket maximum is the most you'll pay in a single year before insurance covers 100% of everything. In 2026, this cap is $9,200 for individuals and $18,400 for families on ACA-compliant plans. One critical concept: in-network versus out-of-network. Every health plan has a network of doctors and hospitals that have agreed to negotiate rates with the insurer. Seeing an in-network provider means your plan covers a much larger share. Seeing an out-of-network provider can mean paying dramatically more, or in some cases, paying the full cost yourself. Always confirm a provider is in-network before an appointment, not after. The second type is auto insurance. In the US, auto insurance is legally required in almost every state if you own and drive a vehicle. But not all auto insurance is the same, and the minimum required by law is often far less than what you actually need. Liability coverage is the part that's legally required. It pays for damage you cause to other people's property or bodies when you're at fault in an accident. It does not cover your own car or your own injuries. That's handled by separate coverage types. Collision covers damage to your own car from an accident regardless of fault, and comprehensive covers damage from non-collision events like theft, flooding, hail, or hitting an animal. If your car is financed or leased, your lender will almost always require you to carry both collision and comprehensive in addition to liability. Once your car is paid off, you have the choice to drop those. But whether that makes financial sense depends on the car's current value versus the additional premium cost. One thing most drivers don't know: the minimum liability limits required by most states are dangerously low. A state might require only $25,000 in bodily injury coverage per person. But a single emergency room visit can easily cost more than that. Carrying higher limits is almost always worth the small additional premium. The third type is homeowners insurance, and its companion for renters: renter's insurance. Homeowners insurance covers your home structure and your personal belongings against damage or loss from covered events: fire, theft, certain weather events, vandalism. It also includes liability coverage if someone is injured on your property and sues you. If you have a mortgage, your lender requires you to carry homeowners insurance. One important detail: standard homeowners insurance does not cover flood damage. Flood insurance is a completely separate policy, typically purchased through the Federal National Flood Insurance Program, and many homeowners in flood-prone areas skip it, often finding out why that was a mistake too late. Renter's insurance is one of the most underused and undervalued products in the country. It covers your personal belongings if they're stolen or damaged, and it covers your liability if you accidentally damage the building or injure someone. The average cost is $15 to $30 a month. If your apartment burns down and you don't have renter's insurance, every piece of furniture, every electronic, every item of clothing you own is simply gone with no recourse. The fourth type is life insurance. Life insurance pays a lump sum to your named beneficiaries when you die. There are two main categories: term life and whole life. Term life covers you for a specific period, 10, 20, or 30 years, and pays out only if you die during that term. If you outlive the term, the policy expires and you get nothing back. Whole life covers you for your entire life and includes a cash value component that grows over time and can be borrowed against. Term life is almost always the smarter financial choice for most people. It's dramatically cheaper than whole life. A healthy 35-year-old can get $500,000 of 20-year term coverage for around $25 to $35 a month. The primary purpose of life insurance is income replacement for people who depend on you financially. If you have a spouse, children, or anyone else relying on your income, not having life insurance is a significant financial risk to the people you'd leave behind. The fifth type is disability insurance, and this is the one most Americans overlook almost entirely. Disability insurance replaces a portion of your income, typically 60% to 70%, if you become unable to work due to illness or injury. Short-term disability covers a few weeks to a few months. Long-term disability can cover years, or even until retirement age. Many employers offer some form of short-term disability coverage, but long-term disability is far less commonly provided, and the coverage that is provided is often inadequate. This matters more than most people realize. Here's the number I promised you. According to the Social Security Administration, a 20-year-old worker today has more than a 1 in 4 chance of becoming disabled before reaching retirement age. Not dying, becoming disabled, unable to work, for months or years. And yet most Americans have no long-term disability coverage at all. If you became unable to work tomorrow, not for a week, but for a year or two, or permanently, do you have enough in savings to cover your living expenses, your mortgage or rent, your car, your family? For most people, the answer is no. Long-term disability insurance exists specifically for this scenario, and it's one of the most commonly skipped and most genuinely critical insurance products available. The sixth type is umbrella insurance. This is an additional liability policy that kicks in when your auto or homeowner's liability coverage hits its limit. If you cause a serious car accident and the damages exceed your auto policy's limits, an umbrella policy covers the gap, up to $1 million or more. Umbrella insurance is relatively inexpensive, typically $150 to $300 a year for $1 million in coverage, and it's particularly valuable for homeowners, people with significant assets, or anyone whose job or lifestyle creates elevated liability exposure. Insurance as a category is easy to dismiss as an expense until the moment you need it, and at that point, it's either the best money you ever spent or the worst mistake you ever made. The goal isn't to buy every policy that exists. It's to understand what you actually own, what gaps you have, and which of those gaps represents a financial risk you genuinely couldn't absorb on your own. Health, auto, renters or homeowners, life if people depend on you, and disability, especially disability, are the 5 categories worth taking seriously before anything else. None of this makes sense on purpose. Now you know. More than most people ever will. Subscribe if you want to keep stacking knowledge like this. See you in the next one.